Join us now at the FinTech TV set, Joe Benaroche. She is the head of media partnerships, content, and distribution here at the New York Stock Exchange. Great to have you.
Well, thank you. You're an incredible part of our team.
And a very happy New Year to you as well. We are so excited to launch Taking Stock, our daily closing bell show here at the big board on Reach TV. Joe, from where you're situated, why was this the right time? And why is this the right partner?
Right time because the NYSE is continuing to scale all of its resources across our marketing, our media, our content, all of our distribution, everything that we're creating on behalf of all of our listed companies, all the tens of thousands of private companies that we work with. All of those media and marketing resources continue to be a massive investment for us. And when we look at the last year, we have scaled partnerships almost 30 times more than we've had ever. We've increased all of our distribution by, tens to hundreds of million. And Reach TV is a natural part of that extension, considering where the business community ultimately rests. If you think about all of the travel, everywhere that they have all of their locked in already distribution network, Reach TV is a perfect extension. So if you put us on paper, we're automatic partners. As an extension of our wonderful partnership with FinTech, the things that we're doing with Money 2020, everything that we're doing with Cheddar, everything that you're involved in, it was a very natural fit to make sure that, the people that we are consistently trying to reach every day had access to all of the information that we're putting out in the marketplace.
Joe, when you take a look at the broader New York Stock Exchange community today, I wonder how different is the way that you're thinking about distribution, even compared to where we were this time last year?
Well, this time last year, it's a perfect way to look at it. This time last year, we had just launched what we called Partnership Day, or we were gearing up for Partnership Day in February. We were essentially opening ourselves up as an organization, no different than any other media organization. So I have, a long history at NBC Universal, and those media organizations do what they call an upfront. And that upfront is basically to put out upfront into the marketplace all of the ways in which they can partner with you. Well, the New York Stock Exchange did exactly that. So from a year today, we have more creative partners, more content partners, more media partners that are coming not just to the floor, but that we're working with, more platform partners. We're looking at all of the new content creators. We have a wider distribution network. We have, I think we've increased the content that we've created almost by 100% year on year. We have, 1 million downloads to our podcasts alone. We have about 200 million reach on all of our distribution on the content that you're creating, that, Kristen Scholler and Ashley and team are creating. And why that's important is because the New York Stock Exchange views itself as a way to impart the information and narratives of all of those companies that I had mentioned earlier, all of those listed companies and all of those tens of thousands of private companies and all of the partners that we work with. So having that distribution is really important for us, but it all centers around the partnerships that we create, because we don't view ourselves as competitive to any other news network. That's not what we want to do. What we want to do is we want to be a partner to any content creator or any news or media organization.
This is an iconic institution. We draw our origins all the way back to 1792. The building, this iconic trading floor you and I are sitting on, this building opened up all the way back in 1902. But the audiences that we distribute our content to, the audiences are everywhere. How has the New York Stock Exchange continued to adapt that content strategy to actually meet people where they are?
That's a good question. And what I like is that you talked about our history. We are a 233-year-old organization. The New York Stock Exchange has rode and been a part of every single wave of technological innovation, from the from the telegraph to AI to every single platform that exists, from space to electronic vehicles. We have seen every wave of technology from 1792 to today. And so as part of that, we have platforms that are naturally part of the New York Stock Exchange, the fabric of our listed companies, and we work with every platform. We work with every single organization that is working to adapt AI within the fabric of their own company. And so for us, it's just very natural that what we're doing is working with every content creator or every platform. I'll give you an example of a platform, LinkedIn. While LinkedIn is a platform that has 1 billion people that they're connecting around the world, and they're connecting all of these businesses, they're also a publisher of news. So they will be right here on the floor, no different than the things that we're doing with X or the things that we might be doing with Snap, who's a part of our listed community.
Joe Benaroche, head of media partnerships, content, and distribution right here at the one and only New York Stock Exchange. Joe, thanks a lot.
Thanks, my friend.
There you have it. That was an interview with Joe Benaroche we recorded last week here from the big board. Joe's, of course, the head of media partnerships, content, and distribution here at the New York Stock Exchange. Your final tail of the tape for this, the very first trading Monday of 2026. The S&P 500 will finish in positive territory, 0.6%. The Dow 30 having a very strong day on the back of names like Goldman Sachs and Caterpillar, up more than 1%. The New York Stock Exchange Composite Index reaching a fresh all-time high, up, let's call it 0.9, and the small caps enjoying a strong rally on the day as well, up 1.5%. For anyone at home who had been wondering, did Santa Claus come to town? Unfortunately not. We missed a Santa Claus rally here for a third consecutive year, only by 7 points in the S&P 500. Let's bring in someone far smarter than I am about all of this, the great Hartika Singh. She is economic strategist at Fundstrat. Happy New Year, and thanks for being here.
Happy New Year. How's it going?
Well, it's much better now that you're here, and we're here for a new year. Investors feel pretty good about where things are, but we missed a Santa Claus rally. Is this a big deal or something you've been tracking?
No, not at all. Santa unfortunately didn't come to town, but it doesn't mean the end of the world. We still have the January barometer to keep an eye out for. Of course, in the grand scheme of things, these 1 month performances, they don't really matter all that much, right? But it is nice to see when these things happen because it's one of the first meaningful tests for the stock market. So if they do go up, it reaffirms this bull run that we've had, especially coming off the back of 3 years of back-to-back blockbuster gains, right?
Let's talk a bit more about the January barometer. Historically, it basically goes as January goes, so too goes the S&P 500. Not a one-for-one perfect correlation historically, but what are you looking for in the first 4 weeks of the trading year to give you some sense on the risk-on appetite for investors for the rest of this year?
I think we really have to see Magnificent Seven stocks here start to rally a little bit. Last year, Mag 7 became the Lag 7, right? It was more Palantir, more AMDs, more Oracles, and even Corby's, which aren't really all that good companies, right? They were rallying a lot more. And I think that if the Mag 7 can turn around here, it would sort of reaffirm, again, things for the bull run because they have really high free cash flow, they have really strong fortresses of balance sheets. So we need to see them kind of deliver on this AI promise over the past, that they've been like telling us all about for the past few years.
Hartika, what are you and the team at Fundstrat watching with regards to this weekend's military intervention into Venezuela? Is there some underlying geopolitical tension that investors in equity should be paying attention to as we move forward with the month of January?
Well, despite all the chaos of the weekend, we saw stocks rally for the second trading day of the year, which is huge, right? And I think it's really because of the past 5 years, investors have been trained to just sell the rumor and buy the invasion, given what happened with Russia, Ukraine, and all the Middle East tensions. So I think it doesn't really matter all that much here because we've seen in the past these geopolitical tensions, they don't have a long-lasting impact on the stock market.
Now that we've got, for the most part here, I guess unfortunately the holiday season is done. I know that because the Christmas trees are coming down, everyone's taking down their lights. What do we see in terms of the strength of the consumer, specifically for Q4, the heart of the holiday shopping season, where maybe people had been sort of saving to spend more of that discretionary income? Was it a strong season overall, you think?
It was a very strong spending season. Now the big question is, what's fueling all this spending? And according to the GDP report, it seems like a lot of consumers are pulling money out of savings to pump up, their spending and vis-a-vis the economy. According to the GDP report, we saw that savings rate as a percent of disposable income grew at a 4.2% annual rate from July through September, which is the lowest growth since the fourth quarter of 2022. Now, flashback to what was happening then was people had their savings built up from the pandemic, and then as the bear market happened and the job market became a little bit more difficult, people started to chisel away at those savings, and that became difficult. So I think we really need to see consumers have strong balance sheets here to continue to pump up the spending.
Hartika Singh is economic strategist at Fundstrat, kicking off our broadcast here for the first Monday of 2026. Thanks for being here. Good to have you as always.
Thank you.
Josh will grab your mic. Jeff, you and I are going to head this way and go for a walk. Hi, everyone. Pardon me, one and all. We're bringing the updated Poly Market odds here as participants are trying to figure out, this is a good one. Who will be the Super Bowl champion on February 8th? I got the odds you need to know. The Seattle Seahawks, odds-on favorites, not overwhelmingly so, but at 19%. The LA Rams at 16, Denver Broncos at 11. The Philadelphia Eagles, 10% odds to run things back as back-to-back Super Bowl champion. Buffalo at 9%. We're going to eke around this way, excuse me. New England Patriots at 8%. Houston and Jacksonville at 6%. The other teams low single digits. The playoffs officially kick off for the National Football League this Saturday, 4:30 p.m. between Carolina and the LA Rams. Super Bowl Sunday, February 8th in Santa Clara, California. Maybe the 49ers get a home game for the Super Bowl. That'd be kind of cool. All right, we'll take a look at two NYSE notables here before we toss a break. First up, after the military intervention in Venezuela, a strong pop in shares for Chevron, up about 5%. Of course, Venezuela, a founding member of OPEC Plus. Analysts say, look, when you take a look at all the big oil and gas and energy giants, Chevron's probably the one best positioned to boost crude oil production. Shares of Chevron not quite reaching a 52-week high in the session today, but it did have a big gap up after the opening auctions here on Wall Street. Finally, let's take a look at shares of an ETF you might not be familiar with. It is ticker symbol XAR. This is the State Street Aerospace and Defense ETF, reaching a fresh all-time high today, up 20% off of its mid-November lows. This ETF's some of the most weighted names include stocks like Rocket Labs, Boeing, and RTX. That's, of course, the old Raytheon. This time last year, XAR was trading only at $169 a share. It is now up more than 50% in the last 52 weeks. Don't go anywhere. Much more Taking Stock coming up live from the New York Stock Exchange right after this. Welcome back to the New York Stock Exchange. You are watching Taking Stock. Time now for a few headlines in the worlds of fintech, crypto, and artificial intelligence you need to kick off the first full trading week of 2026. First up, the crypto majors are all up at long last if you are a crypto investor. Bitcoin, ETH, Solana all up more than 3%. Bitcoin reclaiming a 94,000 handle for the first time since around December 12th. Next up, Polymarket partnering with Parcel to turn U.S. home price indices into prediction markets. It's a move that will allow users to bet on whether housing prices rise or fall across major U.S. cities. And finally, according to a survey by the Financial Times, most economists expect the U.S. to extend its productivity lead over other major economies, driven by things like AI investment and deep capital markets. Alexander Lin joins us here live on the trading floor of the big board. Alex is co-founder and general partner at Reforge. Great to have you here.
Thanks for having me.
And a very happy New Year to you, first and foremost.
Happy New Year.
Okay, so, well, it's great we're doing this conversation on a day when the Bitcoin or the crypto majors are actually up. Anyone who watches the show knows this is always the time. It seems like doom and gloom for the last 3 months. How are you thinking about performance for the crypto majors as we officially kick off a new year?
Yeah, taking a step back, I think we're in this slow bull cycle where we forget about the 4-year cycle. I think that's long gone. So I think it'll be a perpetual up. From my stance, and there are several reasons for that. Obviously, there's a lot of concern over the fiscal deficit. There's a lot of concern over how do we mitigate against the risk on the debasement trade. Obviously, gold and silver outperforming Bitcoin this year, but I think that with Bitcoin and a lot of the other majors that follow, because it's a rising tides raises all ships, we're going to see continued growth. We're going to see a lot of institutional interest continuing to get net new positive inflows through ETPs. And I don't think that's stopping anytime soon. I would say 2025 was more about consolidation, and I think 2026 is really activation, right? Really taking what was built with a lot of the regulatory clarity, with Genius and Clarity, and going to 2026 saying, hey, we're getting the green light, right? New administration, now in our second year. I think there's a lot of excitement for what's to come.
What additional regulations do you think should still be considered by policy and lawmakers down in Washington? You mentioned a few of them. That was progress in 2025. Is the work finished, or do you sense that there might be kind of additional work? It is a midterm election year, which has its own
That's
challenges
true.
for
That's true.
policymakers, but what more needs to be done in the space, you think?
A lot, I would say, but I'm optimistic. Every step is in the right direction, and so I think with Genius, there still needs to be clarity on Genius, specifically around what actually constitutes, how do we constitutes the bridge between the SEC and CFTC. But I think that just that in of itself is progress, right? We're making doing a lot of work in ensuring that the assets that we're trading, that retail is trading, that institutions are getting involved in, are legitimate. And so I think that we're headed in the right direction, but I still think that even with the existing acts with Genius, for example, we still need to make a lot more progress.
I'm curious about some of the ways you're seeing artificial intelligence change the general landscape of investing. And talk to me about some of the ways that you and your team at Reforge are using even things like AI agents.
Yeah, so very loaded question, but I guess at a high level, it changes the game, right? So AI now turns everything into machine speed. We are seeing effectively everything kind of moving onto crypto rails because legacy infrastructure cannot handle the linear kind of pacing or the exponential pacing that exists with AI. When it comes to venture, it's a completely different ballgame. So we actually built in-house AI stack, an in-house AI stack called Ava and Alice that sources deals for us and also does the diligence for us. So we run a very lean team, but just with our lean team, we're able to look at thousands of deals a week. We're able to parse through them, and so we have effectively the manpower of 10 analysts working with us just through these agents. So from an operational perspective, it's incredible progress, but then obviously in the industry, there's a lot to look at across agents, payments, and how that could be impacted, and then obviously trading.
Alexander Lin, co-founder and general partner at Reforge. All the best for 2026 to you and your colleagues. Thanks a lot for being here. Good to have you.
Thank you very much.
Don't go anywhere. Much more Taking Stock coming up after this quick break. Welcome back to the broadcast. You're watching Taking Stock for this, the first Monday of 2026, live from the trading floor of the New York Stock Exchange. Let's say hello to our next guest. This is Michael Krimenak. He's the trustee and president of Thrivent Funds. He and his team just rang the closing bell here at the big board to kick off the first full trading week of the new year. Thanks for being here.
Thanks so much for having me.
Can I get first and foremost, we're sitting here, we got the Thrivent logo up on all these screens because you just did the honors. What was it like to ring the bell for us here at the big board today?
It was so exciting. We were so proud of what we've built with our ETF complex, so it was so neat to be here to celebrate this moment with our colleagues here at Thrivent.
Let's talk about those ETF complex, the product suite. You got mid-cap value, ultra-short bond ETF. I was doing my homework earlier today. Why have you chosen the specific product suite of ETFs right now? And what does kind of retail investor appetite or reaction look like to kind of inform what products you actually put out to market?
Yeah, so if you look at any product, whether it's ETF or other investment products, we're really looking for products that our clients can use as long-term investments. And then we also want to use asset classes where we have really strong capabilities as active asset managers. And so we have great capabilities in small and mid-cap equities and in fixed income, and so those are the asset classes we've started in, but you'll see more ETFs and other asset classes in the future.
How do you go about separating signal from noise in terms of knowing which core financial products are ready to ship versus which ones you may not want to roll out just yet?
Well, so we're focused on the long term. So we're not really trying to time an exact strategy at a certain time. So what we're really looking at is, do we have the right people, the right processes to add long-term shareholder value in a certain strategy?
What would you say is your overall ETF outlook for 2026? We're talking a lot about automated trading and AI and technology and the role for an ETF space. And now we got more ETFs than we do actually publicly traded companies.
Yeah, it's such an exciting time to be in the ETF space. We see continued growth in the market overall, and we think we're going to continue to gain market share with our ETFs.
What do you see is most resonating with investors, and why do you think the core products like ETFs are so popular with so many people out there?
Yeah, so I think for us, what we see is they want to work with a company that they can trust, and Thrivent has been around since 1902, and so it's a company that's been around for a long time. We launched our first mutual fund in 1972, and now that we're getting into ETFs, it's just we're building on that legacy that we've built over 100 years at Thrivent.
How do you build on that legacy, the original core values going all the way back to 1902, but still stay nimble in a world of financial markets that are evolving by the day?
Yeah. It's amazing. I feel like each day the world moves quicker, and that's certainly true in the financial services world. So it's important that we are staying in tune with what's going on in the markets and bringing in new talent, and really just staying up to speed on what's changing in the world around us.
How do you see yourself and your investors navigating interest rate uncertainty or any other core points of uncertainty? It could even be geopolitics, which obviously we're contending and talking a lot more about today than we thought we would coming into the weekend. But all those big question marks for 2026 hanging over the markets.
Yeah. So there's no shortage of uncertainty in all sorts of places, and what we think is that if investors stay diversified, they will be rewarded in the long term, not to worry too much about the noise going on day to day, the ups and downs, but build a diversified portfolio, and things will turn out well in the long term.
Michael Krimenak is the trustee and president of Thrivent Funds, also rang the closing bell here at the New York Stock Exchange. Really great to have you. Happy New Year to you.
Thank you. You too.
Don't go anywhere. Much more Taking Stock coming up after this quick break.
Welcome back. I am Scarlett Sieber, and this is Hindsight 2020. where history proves that cancel culture isn't new. It just used boats instead of hashtags. And yes, I'm wearing a Yankees hat because we're going to be talking about the Boston Tea Party, and I cannot be talking about Boston without putting on some Yankees gear. Today, we're going to be rewinding back to December 16th, 1773. That's in the Wayback Machine. And that night, a bunch of colonists said, taxation without representation, hard pass. So what did they do? They dumped 342 chests of tea into the Boston Harbor. It was the ultimate unfollow before that was a thing. Here's the financial tea. This wasn't just a protest, it was a market disruption. Britain's East India Company was basically the Amazon Prime of its day, and the Tea Act was their subscription model. Colonists weren't having it. They canceled that membership in the most dramatic way possible. The ripple effect? It was massive. The Boston Tea Party sparked the American Revolution, which led to independence, a new currency, and eventually, Wall Street. Without this salty stunt, there's no dollar dominance, no NYSE, no Dow Jones Industrial Average trending on your feed. So next time you rage quit a streaming service, remember, the OG cancel culture didn't just change entertainment, it changed global finance as we know it. Until next week when we talk about a December moment that flipped tech on its head. Back over to you.
Welcome back to the broadcast. You're watching Taking Stock in our remaining moment. We'll get you quickly updated on what to expect tomorrow, but also what happened today. The risk on trade alive and well on this, the first Monday of 2026. The S&P 500 rising 0.6%. The Dow Jones Industrial Average 30 components rising 1.2. The NYSE Composite Index up 0.9 to a fresh record high. And the small caps in on the fun as well, up 1.5. Although sadly, Santa Claus did not come to town here on Wall Street for a third consecutive year. Tomorrow, Richmond Fed President Tom Barkin will speak. We'll also get the final reading on services, PMI, 9 a.m. NYSE TV Live and FinTech TV Live, both down here. Count you down to the open. That's going to do it, and we will see you again tomorrow.